Welcome to StockMarketFunding.com, our live training session on Saturday with a great group of SMF Pro trading students. 30-year veteran master trader Mario Marciano is hard at work recapping the weekly chart on the vix.x, which is referred to as the fear indicator and volatility index, which equals and correlated with the S&P 500. And basically what Mario is going to show you is that back in October, and we did this trade here. This is when I was in Hermosa Beach in the beach house when we did this trade. And we bought the calls on the VIX. We broke out. Then we came all the way back down through the rest of the year as anticipated we would. But let's take a look at the same pattern in nature. Last week we went down and we tested these weekly moving averages, but as everyone is taught in the pro trading school, it's whether it's a 3-minute bar, 15, 60, daily, weekly, monthly, yearly, quarterly. If we hold above half of the SMF weekly pro trader bar and we don't close below it and we set it up here, we're going to go higher in this VIX. And if we go higher in the VIX, that means that the VIX calls that we bought, which were the $18 calls at the time, they were slightly up and out of the money a little bit. And you can see here where we bought these things down here, and you can see the swing low. I'll show you the swing low of these contracts. The swing low was 350. The swing high in the contracts were 760. That's a 100% move, trading that volatility in your favor and hedging your portfolio or learning various risk management tools. So if you bought 100 contracts for $4, that's $40,000 entry, and you sold up here already, you could have made $30,000 very easily in that double week hedging your portfolio or your mutual fund. And people that have IRAs and don't have the experience, we just want to open up your eyes and invite you, and that you can get proactive and you don't have to let the markets destroy you, and that you can use proactive risk management tools here to offset losses in other areas and take an income. So basically that's the weekly chart. I'm going to go back to the daily. And on the daily, here are the call contracts. 1, 2, calls go up. They kind of pull back. They gapped them up. We've come down a little bit, but we're not going to sell it yet. We've sold some. Some of our traders took half off on the volatility spike, but remain in the other part. If we break down any further in the indexes, we're going to go very high here on these calls. But let me show you where the VIX can go. And let me show you here that the last highs are up here. And we traded this. I'm showing you from a daily chart now. And this is that same area on the weekly here. And basically what we did was that this was back on 121 right here. We shot straight up here on that daily, and then back over here when we put in the blow-off bottom. That was a blow-off bottom. At the time that we put that blow-off bottom in, we were putting a blow-off top in the indexes, and they run invert. They don't run together. Okay? If this goes higher, stock market indexes and stocks go lower. If the stock market goes higher, then this will go lower always. They're totally invert. And when it comes time to using trade management, I said that we would put in a blow-off bottom. That's a breakout. This was the last highs that occurred in this consolidation. And I have my logo here. And basically, what I want people to know is that this is where we are right now. So we're going to see if we break the current tops. If we do, we're going to go lower in the indexes. If we do not, if we come up and make a double top and we don't break through resistance, we're going to sell our VIX calls as far as the calls. And if we don't break through that top and we set in a bottom in the short-term trend on the S&P, then we are going to go long the S&P calls if we can't break that top here. And another thing I would like to point out is that when you look at this high right here, this high here is lower than the previous high of the last up move that we had when the markets were correcting. So we're going to be very mindful in teaching people about what to do with this here. And it's a lagging indicator, but can be traded for a profit at various extreme movements. The best time to trade these calls on the VIX is when you're at highs in the indexes at resistance and they reverse. You buy these and you make a short-term gain. There are so many things that you can do here. And it's relative to the S&P 500 because it is. And I just want you to see the top here. You can see that diagonal trend line here. So we're going to be very mindful, and we're going to see here on the daily of how do we hold that initial breakout here. Here's the first daily bar up. There's the second. There's the pullback to test that support. And now we're going to see if we break through that trend. If we do, I promise you that this S&P is going to drop down to the 1050 level. And if we drop down there, we don't have any support till we get right above the 200-week moving average on the daily on the S&P. And this is the S&P 500 daily chart. So if this goes down, the VIX will go higher, and we'll let the rest of the call contracts go. If we get support and we're going to get a short-term reversal, we'll cash out of the VIX or keep the VIX calls and go long the S&P against the VIX calls. So that way we're hedging our gain. And so I just want people to know here, this is a very sick daily chart. Daily moving averages are crossing over, break below the 100-day moving average. Couldn't take out another. See, you had a topping pattern up here, and now you have a much, see that top up here, and it started with the sell. We'll look at this top here, and it's starting with the 2 days of selling again, and we have breached some daily moving averages. That's how you trade with risk.